Have you ever wondered what separates good investors from the truly great ones? It's not just about crunching numbers or predicting market trends. The real secret lies in their mindset. Today, we're diving deep into the psychology of elite investors. Inspired by the groundbreaking work in behavioral finance in books like Thinking, Fast and Slow by Daniel Kahneman, we'll uncover the mental models that help them navigate the chaos of the market and make winning decisions. This isn't just for Wall Street pros. These insights can help you make smarter choices in your own financial life. So, let's get into the first core idea: conquering our own biases. Our brains are wired with mental shortcuts, or heuristics, that help us make quick decisions. But in investing, these shortcuts can lead us astray. One of the biggest culprits is confirmation bias. This is our tendency to seek out information that confirms what we already believe and ignore anything that contradicts it. For example, if you're convinced a certain stock is a winner, you'll probably only read positive news about it and dismiss any warning signs. Elite investors actively fight this. They intentionally seek out opposing viewpoints. They ask themselves, what if I'm wrong? What's the strongest argument against this investment? This intellectual honesty is crucial. Another sneaky bias is loss aversion. Psychologically, the pain of losing $1 feels twice as strong as the pleasure of gaining one. This makes us hold on to losing stocks for way too long, hoping they'll bounce back, while selling our winners too early to lock in a small profit. The great investors, like Warren Buffett, have a simple rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't about never making a bad investment. That's impossible. It's about having a disciplined process to cut losses before they become catastrophic, overriding that emotional instinct to just wait and see. The second key concept is what's called probabilistic thinking. The future is uncertain. There are no guarantees in investing. Instead of trying to predict the future with 100% certainty, elite investors think in terms of probabilities and potential outcomes. They don't just ask, will this stock go up? They ask, what are the different possible outcomes? And what is the likelihood of each one happening? What's my potential upside if I'm right? And what's my potential downside if I'm wrong? This creates a framework known as asymmetric risk. They look for investments with a potential gain as many times greater than the potential loss. Imagine you have an opportunity where you could lose $1, but you could potentially make 10. That's an attractive bet, even if the chance of success isn't guaranteed. This approach, championed by investors like George Soros, forces a more rational and less emotional decision-making process. It's about making calculated bets where the odds are stacked in your favor over the long run, not just hoping for a single lucky break. They understand that you don't have to be right all the time. You just have to make more money when you're right than you lose when you're wrong. Our third idea is the power of a long-term temperament. In a world of 24/7 news cycles and instant stock tickers, it's easy to get caught up in short-term noise. The market goes up, people feel euphoric. The market goes down, people panic. Elite investors cultivate a powerful sense of patience and emotional detachment. They understand that real wealth is built over years, not days. They focus on the fundamental value of a business, not its fluctuating stock price. This is the essence of value investing, popularized by Benjamin Graham and perfected by his student, Warren Buffett, famously said, "The stock market is a device for transferring money from the impatient to the patient." He doesn't check his portfolio every 5 minutes. He buys great companies at fair prices and is prepared to hold them for decades, letting the power of compounding do its magic. This long-term mindset acts as a shield against the emotional roller coaster of the market. It allows them to buy when others are fearful and sell when others are greedy, which is often the most profitable, though psychologically difficult, thing to do. Let us look at a classic story that illustrates these principles perfectly. The story of Warren Buffett's investment in American Express in the 1960s. The company got hit by something called the salad oil scandal. One of their clients defaulted on huge loans secured by tanks of salad oil, but it turned out the tanks were mostly filled with water. The market panicked. Everyone thought American Express would go bankrupt from the liability, and the stock price plummeted by 50%. People were selling in a frenzy, driven by fear and herd mentality. But Buffett didn't panic. He did his homework. He went to restaurants and banks, Observing that people were still using their American Express cards and traveler's checks, he realized the company's core business and powerful brand was still intact. He saw that the market was overreacting to the scandal. He calculated the potential losses and realized they were manageable for a company of that size. So, while everyone else was selling, he invested 40% of his partnership's capital into American Express stock. He was thinking in probabilities, ignoring the short-term noise, and acting against his own potential biases. Within a few years, the stock price had soared, and he made a massive profit. That's a masterclass in applying psychological discipline. So, how can you start applying this elite investor mindset today? Here are a few actionable takeaways. First, create an investment checklist. Before you buy any stock or investment, write down the objective reasons why you're buying it. What is the company's value? What are the potential risks? What's your target price to sell? This forces you to think rationally and prevents you from making emotional, impulsive decisions. If the situation changes, you can refer back to your checklist and make a logical choice. Second, practice seeking out disagreement. The next time you're excited about an investment idea, actively search for the 3 strongest arguments against it. Play the devil's advocate for your own ideas. This will help you build a more robust and balanced view, protecting you from confirmation bias. Third, adopt a do-nothing default. The best action in investing is often no action at all. When the market gets volatile, your first instinct should be to sit back and reevaluate, not to immediately buy or sell. Give yourself a cooling-off period, like 24 or 48 hours, before making any major moves. This helps you detach from the short-term panic and focus on your long-term plan. To wrap it all up, the key to becoming a better investor isn't some hidden algorithm or secret formula. It's about mastering your own psychology. It's about recognizing and conquering your biases, thinking in terms of probabilities, and cultivating the patience to play the long game. By building a disciplined mental framework, you can protect yourself from your worst enemy in the market, yourself. You can learn to make rational decisions when everyone else is driven by emotion. Thank you so much for watching. If you found this helpful, please hit that like button and subscribe for more content on mastering your financial life. I highly recommend checking out books like Thinking, Fast and Slow to dive even deeper. Let me know in the comments what psychological trap you find hardest to avoid. See you in the next video.